Hello and welcome to episode 478 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. I'm actually excited because a number of Money to the Masses listeners are, as we speak, testing the new app that I've been talking about in recent weeks. So thank you to everybody who joined the Facebook group and volunteered to help us with the testing of the new app. So that's underway. We're already getting feedback about it, and I can't wait to be able to talk more about it in the coming weeks and tell you what it actually does, because I think a number of the people who are testing it were pleasantly surprised about how good it is. So thank you to those people who volunteered. You will be getting Money to the Masses mugs, even if you weren't selected to be part of the group of people that actually got to see the new app. So that, Andy, is the most exciting thing this week. But going on to what's on the show, well, we've got three pieces as usual. We're going to do a savings piece. Now, we've done savings recently, but there's been a big change in the savings market in terms of where the best rates are. So historically, you had to shop around, but we want to talk about cash savings platforms and investment platforms that are offering the best rates. Now, it will make more sense when we get to it, but it's an area of the market where I think a lot of people aren't looking for the best savings rates at the moment, especially as savings rates are coming down. The second piece I'm going to be doing is an investment piece about China. So we haven't spoken about China on the podcast for quite some time, but if you are into investing, it probably hasn't passed you by that the Chinese stock market exploded higher in the last week or so, and there will be a lot of people who are wanting to gain exposure to that. I'm going to explain what happened, why, and how you can get exposure to that indirectly in a slightly clever way. And the final piece on the podcast is a new development in authorised push payment fraud protection. So there are new rules that the banks and building societies are going to have to abide by now when it comes to dealing with reported fraud cases. So Andy, shall we get on with the first piece of the podcast? It's actually to do with savings, as I've mentioned, and savings platforms and investment platforms when it comes to savings and the best savings rates, which is slightly unusual. Now, what I'm going to do is go through and give people a bit of a history as to how we've got to where we are. And then, Andy, you're going to talk about some of the rates out there that you can actually get. So in order to get the best savings rate, what you'd normally do is shop around, look at the best rates out there. For example, we've got a range of tables that we update every week on the Money to the Masses website. We'll put links to them in the show notes, where we look at and compare the best rates out there on all types of savings accounts. Now, historically, fixed rate bonds were the way you'd probably get the best savings rate. So the longer you locked your money away without access to it, the better the savings rate. Now, we are in a world where easy access accounts are generally providing better rates than the longer term fixed rate bonds, and that's because there is the expectation that the Bank of England is going to cut the base rate into the future, and we're probably going to head down towards a base rate of around about 3% over the next 5 years. So that's impacted the rates you get on long-term fixed savings bonds. So we're in this world where shorter-term savings accounts, and in particularly easy access, are giving some pretty decent rates, and it's one of the few ways without looking at regular savings rates. That's something we covered on the podcast recently, which limit the amount you can put in a month. Easy access accounts are probably the best way you can try and get above 5% interest still. So that is kind of where we are at the moment. Now, what's happened over time is that there has been a range of cash savings platforms that have launched. So if we go back, I think it's about 2 to 4 years ago, we started to talk about it on the podcast. We did a show talking about cash savings platforms. Now, if you've not heard of them, these are platforms that exist that enable you to access a wide range of bank accounts and building society accounts. So rather than having to go and shop around, then put your money with a bank directly, so you might have to open an account with them, maybe online, or you have to go in person. And then when that account rate dropped, or you decided to move it on to a different one, you'd have to go and open a new account with another bank and building society. It's a very heavy burden in terms of administration. So cash savings platforms came along, and what they do is they allow you with a single login online to access a wide range of savings products, including easy access accounts and a range of fixed rate bonds typically. And so you can move your money between those accounts. So if you taken out a fixed rate bond, for example, and that account had matured, you could get the money and move it into a different account with a different bank or building society with the aim of trying to optimize your savings rate. So that was a real innovation a couple of years ago, but they didn't really explode, and you didn't often get the best savings rates on those platforms. So the market has now changed and it's actually grown. And one of the reasons is because of this environment we are in with interest rates. With interest rates going up, you can get a pretty decent rate of return on savings in the last year or so. And with the market, in terms of stock markets, having a bit of a wobble in the last year or two, and people sit there thinking, well, I can get at least 5% guaranteed on my savings through a savings account. Why would I take the risk with investing? There were a lot of people that were pulling their money out of investment accounts because they were looking for a 5% plus return on savings accounts. Now, 5% interest, just from a historical point of view and my own experience, seems to be the trigger point where you get people who decide to save rather than invest, because they sit there and think, well, I can get 5%, and the long-term average for equity markets is about 5% on top of inflation. That's the kind of return you get annualized each year. Not guaranteed, but that's the kind of long-term average. So when we get 5% interest rates on savings accounts, people start to look at them and they are attractive. Now, as a defensive mechanism, a lot of investment platforms started to try and work out how can we stop people taking money off our platforms, because most of them didn't offer a cash solution. We're going to have to start to build one. And so they started to build these cash savings platforms. So the platform that allows you to move money between different bank accounts and building societies with third parties, often high street names that you will know and recognize. And that therefore enabled them to keep their customers who wanted to move into cash, maybe only temporarily, and then when they want to invest, they may come back again, and maybe they would invest in a stocks and shares ISA, for example. So that was what caused that whole market to explode, to be much greater choice. The other thing we saw was that Hargreaves Lansdown in particular enabled you to use that service of a cash savings platform, because they were really the pioneers in this area in terms of the investment platforms having a cash savings platform alongside the main investment platform. They were the first ones that enabled you to have cash ISAs where you could hold multiple accounts within those. So you could have an easy access account with one bank and you maybe have a fixed rate bond with another bank within the same cash ISA. Now, that has been an exciting development, and in the environment we are now, we can get a pretty decent rate of return on savings still. That has become a major attraction. So the reason we're talking about it on the podcast, having given you that history, is now people need to consider these cash savings platforms because they do often have market leading rates to attract customers. But those investment platforms, and sometimes those investing apps out there that don't have an associated cash savings platform because they haven't built one, they're also offering a cash account that is paying a very attractive rate of interest. So, I'm going to pass over to Andy now, having given you all that history lesson of what's been going on in the savings market. But it means that some of the best rates you're going to see now are actually occurring within investment ISAs.
Yeah, and interesting, you mentioned apps that are also paying good rates of interest on cash. What I'm going to do is I'm going to bring an article from the Money to the Masses website up on screen now. So those on YouTube will be able to see that. Obviously, people listening to the audio version will create a link in the show notes so you can have a look there and follow along there as well. But AJ Bell Doddle, will call them out because in recent weeks, the way the markets and rates have moved in terms of the interest rates being paid on cash, there are some platforms that are now paying less. Well, AJ Bell Doddle has been paying a pretty punchy rate now for quite a while, and where other platforms and other banks and building societies are reducing the amount of interest that they're paying on cash, AJ Bell Doddle, which is an investment app, is still paying that 5.09% AER variable rate, which is very, very good. And if you can see on screen now, this is a list of investment platforms that pay interest on the cash held within the platform. So it's slightly different to what Damien was talking about earlier. And actually, we'll cycle back to that in a little while. We'll be talking about those savings platforms that investment platforms have alongside their main product. What we're talking about now here is investment platforms also paying an element of interest on the cash that people hold within the platform that's not yet invested. And the reason that they've done that, a lot of the investment platforms, again, saw some big outflows after the pandemic where the cost of living crisis kicked in and people were looking to move their money over into something a little bit more, say, safe than the volatile markets that were happening at the time. And so we saw investment platforms starting to increase the amount, or in some cases, introduce an element of interest on the cash held. So we've got the details here on screen. You can have a look through them. And we've created an easy to see heat map of exactly how much interest you'll be paid on certain amounts of cash. And you can see there, AJ Bell Doddle is streets ahead of everyone else, 5.09%. Now, of course, that interest rate is variable, so it could easily change, but it's just to highlight to you the amount of interest that you can get on what is ultimately an investment platform, but holding money in cash.
And now the rate of interest you can get varies significantly across different platforms and even on the amounts that you have with an individual platform. So you can get, like Andy said, up to or above 5% with AJ Bell Doddle. The actual main AJ Bell platform, because AJ Bell Doddle is actually its new investing proposition it's got via an app, which is really aimed at a market that wants to do a little bit of investing in funds and a little bit in shares. So it's a slightly different proposition, a more simplified, refined proposition. That is the one that's paying the higher rate. You can get Best Invest paying over 4%, but there are propositions like iWeb that don't pay any interest on any money that's uninvested. So there's a wide range. Of course, you've also got SIPs. On a SIP, they pay money on the monies that are not invested. We've got that on screen, like Andy mentioned. We'll put it in the show notes as well, links you can go through to. But one of the things that also makes this piece relevant now is that the investment platforms that are paying money on the uninvested cash within an ISA, that is technically an investment ISA. But of course, the rules have changed now, so you can move money between cash ISAs and investment ISAs and hold multiple of each within a given tax year. So that was the big change, the fact you could hold multiple of the same type of ISA in a given tax year and contribute to them at the same time, as long as you stayed within that overall allowance of £20,000. That has been a real big change, which means there will be more people willing to perhaps open accounts with different ISA providers to take advantage of these more attractive rates. So the message here is obviously do look around beyond just the usual savings tables, look at investment platforms. And Andy, you're going to go now onto the cash savings platforms themselves, the ones that are just cash, they're not investment platforms.
Yeah, so again, I've put some details up on screen. It's an article on the Money to the Masses website where we compare all of the best cash saving platforms that are out there. And again, we'll put links into the show notes for the people who are listening to the audio version. And you can see up on screen now, Hargreaves Lansdown, Active Savings. They were the pioneers, if you like. Damien's spoken about those. Another one is Raisin UK. They are another big cash platform provider out there. AJ Bell have got their own cash savings hub, as well as the fact they've got their investment platform and their Doddle app as well. You've got Aviva, who's a big pension insurance firm. They've got their own savings platform. Saga, the specialists in over 50s insurances and plans. They've got their own savings platform. That's actually, interestingly, provided by Flagstone, who is another big cash savings platform out there. Interactive Investor are on there as well. Obviously, that's a name you will have heard. They're a big investment platform. Coney Cash Management and Insignis Cash Solutions are the main providers in the UK. Now, we've looked at all of the various different rates that are available on those, how many partner banks that they have on their platform, the minimum deposits. And I won't go through them individually because you can have a look yourself on the article on the website. But having a look through all of those platforms, looking at the best rate that you'll get for short sort of fixed term products, maybe 1 year fixed rates, you're looking at anywhere between sort of 4.5 and 4.85% at the moment for a 1 year fixed rate. And when you compare that to the wider market in terms of if you were to actually shop around individually at all the different rates out there, it's pretty close. That 4.85%, you can get slightly better if you're willing to shop around. But again, the reason you're potentially going to be looking at one of these cash savings platforms is the ease of use, the fact that you've got that one login, that you can move from product to product. And another thing that is a good reason for considering a cash savings platform is they'll send you regular alerts where new products become available and when perhaps your existing products that you've got within that platform are due to mature. So again, all of that within the same platform is another good reason why you might consider it. Looking at the best 5-year fixed rates, long-term fixed rate products, you're looking at anywhere between sort of 3.89% up until about 4 to 4.4% was the best rate I could find. That is on Raisin and Saga at the moment. So again, in terms of the wider market, that's pretty close to what you'll get even if you shop around. So cash savings platforms, Damien, the rates aren't that far off the almost market leading rates. And when you consider the ease of use and everything else, it's just something we thought was a good reason to bring it to the pod.
Yeah, and so, as you say, Andy, to sum that up, I would now, looking around, if I wanted to put money and get the best rate, I would look at the investment platforms out there and the cash savings platforms, because one of the big things is the ease of use and the ability to move money around and get alerted to the best rates that are out there. And these are much more competitive than they ever used to be. Whereas if we go back probably 3-4 years ago, the market was much smaller with less competition and the rates were never particularly market leading. So if you're looking at savings, then do bear in mind investment platforms and those cash saving platform alternatives.
Okay, so let's move on to the next piece in the podcast then. And Damien, you've been having a good look into China. There's been a bit of an explosion in the investment markets in China. Damien, you're going to explain what's happening.
Yeah, so Chinese equities have been an asset class that's been relatively unloved because it's actually lagged the wider markets. If you look a lot of over global stock markets, particularly the US stock market, Chinese equities has always been that market, certainly in recent history, where it's always been the one that people have said that it's about to pick up, but then it's always seems to disappoint. Certainly in 2024. Well, that has in the last week changed. So about a week or so ago, the People's Bank of China, so that's the central bank of China, announced a massive wave of stimulus measures to try and stimulate the Chinese economy. And now the measures include things like cuts to interest rates, lowering bank reserve requirements, which therefore gives them the ability to lend more money to people and businesses. There was some mortgage relief as well, so there was actually reducing the minimum down payment requirements for second homes. There was support for the stock market, and there was also support for local governments to help them with unsold properties. So the Chinese property market has had it's been a bit of a drag on the wider economy. It's interesting if you look at the stats, because the wealth of a typical Chinese household is wrapped up in the property market much more than it is in the UK, for example, or in the US. So the property market matters more to individual sense of wealth and therefore the impact on the Chinese economy. So the Chinese property market has been in a somewhat slump, and they are trying to stimulate that and the rest of the economy as well by creating a huge stimulus package, which is the biggest since the pandemic. So that puts it into context. Now, as soon as that happened, we saw the Chinese stock market explode higher. In fact, on one day alone after the announcement of these stimulus measures, the stock market, so I'm talking about the CSI 300, which is a broad index, and we take it as a bit of a measure of the Chinese equity market, that rallied 11% in almost one day. So we had a rapid rally that erased all of the losses of 2024 and pretty much brought the Chinese stock market back in line with other global stock markets in terms of performance. Now, if we go back to the 23rd of September, since that date, the Chinese stock market has rallied 24%, and that is because of the stimulus measures, but that also includes a 7% fall just a couple of days ago. And that was because of the market being concerned that there wouldn't be as big fiscal measures delivered by the Chinese government. Actually, by the time you've listened to this podcast, they are announcing on Saturday, so that will be yesterday, the fiscal measures that the Chinese government is going to introduce. So that could move markets significantly next week. So keep an eye out on that if you're into investing. So it raised the question, there are a lot of people wanting to gain exposure to Chinese equities, because when we typically get this huge stimulus measures, it is therefore often good for its stock market. Now, putting aside the dangers of the parabolic move reversing, I wanted to talk about how you can gain exposure in a more diversified way. So this came from a piece of research I did for 80/20 investor members. So I'm not going to give you exact funds to invest in. If you want to look at the research, then you can, of course, take out an 80/20 investor trial. But I created a series of heat maps that looked at the funds out there, unit trusts, that you could invest in that could potentially benefit from the stimulus measures. But what is interesting is how I went about uncovering which funds could potentially benefit from this wave of stimulus. And you could therefore take the idea and apply it yourself. So this is really me teaching you how I go about uncovering funds for a particular scenario. So what I did is I looked at a previous time in history, which, just for the record, was the 2nd of February this year to the 9th of February, and then the 23rd of September to the 30th of September. Those two periods cover two announcements of stimulus from the Chinese bank, so the Chinese central bank. Now, the first one was a smaller set of measures, but still significant, and obviously that second time period is the latest set of measures. And if you look at the performance of funds within various sectors versus their peer group, average, and their peers, then you can get a sense for those that benefited most in the rebound. Now, of course, if you want to get exposure to Chinese equities, you could go buy a Chinese equity fund, but that is obviously a very direct way of doing it, and also a much more risky way of doing it. Another alternative would be to buy maybe an emerging market fund and pick one that has exposure to China. You will see that on its fact sheet. Some of them will have maybe 10-20% exposure to China. Obviously, in a scenario like we've got now, when the market is rising very quickly, the funds with the greatest exposure to Chinese equities will fare the best. Conversely, if the market slumps, then those funds will do the worst compared to their peer group. Now, of course, you could look at Asian equity markets and see which had performed the best relative to their peers during those two time frames. But what is interesting is I used that analysis, those time frames, to look at European equities. So why did I do that? Well, because there are parts of the European stock market, so certain companies that rely heavily on the Chinese consumer, so Chinese consumer spending on their products. And it is often things like healthcare, but also things like luxury brands. So by looking at European equity funds and looking how those funds performed in those two time frames I mentioned, the one in February and the one in September, then looking at the ones that performed the best in those time frames consistently, then those were the ones that typically had exposure to stocks that have significant customer bases in China. So you could go one step further even by looking at the common stocks held by the fund managers of the top performing European equity funds during those two time frames, 2nd of February to the 9th of February this year, the 23rd of September to the 30th of September this year, then you can see the companies that are benefiting or set to benefit the most from continued stimulus in China. Now, I'm going to just give you a few of these. I'm not suggesting anyone buys their stock, but it's also a good lesson to work out how equity markets are all interlinked and how the prospect of a company that is on the other side of the world can be interwoven with the outlook for the Chinese economy. So Novo Nordisk is one of those companies. It's in the healthcare sector, and it specialises in things like diabetes care and obesity treatments. And so what you will see is there's increased spending in China. There'll be increased demand for its products. ASML Holding is a technology company, semiconductors. So Chinese investment in semiconductor technology increases the demand for the products of ASML. So that particular sector can benefit from Chinese stimulus measures. Another one is LVMH, which is basically luxury goods, so things like Louis Vuitton. So the Chinese stimulus measures should increase the Chinese middle class and therefore the China consumer spending and therefore the increased spending on luxury goods. Another player, Nestle, they do consumer goods. We all know who Nestle are, and they are the largest global food and beverage company. And so rising demand for premium products that they make in China is more likely because of the stimulus measures. And there is even stocks like Ferrari, which benefited slightly from the announcement of the stimulus measures. So there we go. There's a bit of a whistle-stop tour of Chinese equities, how you could gain exposure in a diversified way by perhaps buying into Asian equities or an emerging market fund, but also how you can be a little bit cuter and get indirect exposure via sectors in Europe. But you can also gain exposure to individual companies that perform very well in periods when we've had these stimulus announcements. The one thing I would say on top of all this, that bear in mind past instances where we've had stimulus announcements, then the market has typically rallied very quickly and then plateaued or pulled back. So it doesn't mean that we're actually going to necessarily have a sustained rally, but if the stimulus measures are big enough, then we could see a continued rally in Chinese equities. But this is one way you could try and play it if you want to, in a more diversified and less risky way.
Okay, so Damien, moving on to the last piece then, we're going to be talking about APP fraud. I myself have received a couple of emails in the past weeks and I was trying to digest exactly what's happened. You're going to hopefully distill it all down and help the listeners too.
Yeah, so you will probably, if you listen to this podcast, received an email from a bank, building society, telling you about the changes to the authorised push payment fraud protection out there, the rules that govern them. And you may have got a number of them and not really paid much attention or not really understood if the changes are for your benefit. Have they actually improved the situation from where we were before? We've covered APP fraud in the past. Just to reiterate and remind people, it's a type of fraud where, for example, you may inadvertently via a scam, it could be things like a romance scam or some kind of spoofing where you're transferring money to somebody who you think it is, but it actually turns out to be a fraudster. You transfer money across to them and then obviously they run off with that money. And you are then left without the money and you approach your bank asking for reimbursement. In the past, it's been a very confusing environment in terms of who would get paid out and who wouldn't. And if you look at the statistics of where we were before this week, because I say this week, the rules have changed. But before this week, it was pretty much a lottery as to what you would get back or what you wouldn't from a bank. And actually some banks were terrible. Most people didn't get reimbursed or refunded if they were a victim of this kind of fraud. And so what's happened, the rules have changed and all banks and building societies have to abide by them now from the 7th of October, and they've standardised these rules. So in the past, where banks and building societies generally seem to be trying to not pay out to people who were the victims of this kind of fraud, and let's be honest, it's not about being smart. It's very, very easy to become a victim of fraud. For example, if you're doing a house transaction and somebody's hacked into your solicitor's email account and told you to transfer money to a particular account, a different one, you might not question it. And therefore, that's how some of these scams have happened. I've heard of people who've become victims of scams like this. It's not that uncommon. The thing is, the new rules should be positive for consumers. So most consumers now will get their money back if they've been a victim of APP fraud within 5 working days. So that significantly sped up the process. So that is a big victory for consumers. So that's the good news. There is also now a uniform process. So banks are required to follow a consistent set of rules when it comes to reimbursing customers, whereas, like I said before, it's a bit of a lottery. The one thing that some people view as a slight negative, there's a cap on the maximum automatic reimbursement for fraud claims. So those fraud claims have reduced to £85,000. That's the maximum. It's fallen from £415,000. Now, that has been a result of obviously discussion with the industry, but the argument is that the percentage of claims that are above £85,000 was relatively small compared to the total number of claims. But then you could argue that some of those victims that have the largest amounts have actually lost significant and damaging levels. So they're talking about life savings amounts. Now, for those people, you can still technically try and get a refund and be reimbursed if you are a victim, but it will now require you to go via the financial ombudsman. So that does add a layer of complexity and confusion, which is a shame. But for most people, they should get their money back relatively quickly because most frauds are below that £100,000 level. Now there's a new shared responsibility part to the rules, so the bank sending the money and the bank receiving the money under the fraud are now having to split it 50-50 when they're looking at the reimbursement. So that means it's encouraging a better environment and better prevention measures from both sides. So that is good news. Now the other thing just to point out, there is a bank fraud excess fee that can be applied to any payment of up to £100. So that is a negative because there are lots of frauds that are for relatively small amounts of money. So therefore the £100 fee could almost negate some of the fraud or the payments that would be made to you after the fraud. So that is a disappointment. That is going to be a case-by-case basis or bank-by-bank basis. So not all banks are going to apply that £100. There's a couple that have come out, Nationwide, TSB and Virgin Money, that say they won't apply it. But others, it's going to be at their discretion. So that is a slight negative. So overall, the change in rules is very positive for consumers. Yes, there's some niggles with the new rules, particularly regard to the high-level fraud. So just make sure if you're transferring high levels amount of money that you do pay heed to any warnings from your bank and building society, and also that you make sure that you check that the person receiving it is who you think it is. Always, I think it's safe to transfer a small amount of money, even £1, to somebody and make sure they've received it and the right person has received it before transferring large amounts. Now, even under the new rules, there will be people who won't be paid out, and that's if they've been deemed to be grossly negligent by their bank or building society. But the bar for that measure is very high. So as long as you've heeded any warnings, for example, from your bank, then you are likely to be paid out. So that is good news, Andy, for anybody out there. Hopefully it means less confusion for people, and more importantly, they're going to be reimbursed much more quickly. One thing being a victim, but it's even worse when you're having to be dragged through the process of having to prove that you were actually a victim. So that's it, Andy. I think we are done for this week on the podcast.
We are indeed. So please do, if you haven't already done so, review the podcast in all the usual ways. It's been a few weeks actually since we've seen any of those reviews or read them out, certainly on the podcast. And if you do, we'll be more than happy to send you a Money to the Masses mug. Follow us on all of our socials in all the usual ways. Do follow us on Spotify as well. We get lots of follows on Spotify. I think adding the video over there is certainly helping. If you watch the video on Spotify, do let us know, because it's something we're doing, something new, and it's always good to hear from people who listen and consume the podcast in a new way. And don't forget, of course, we've got the Money to the Masses Facebook group. It's facebook.com/groups/Money to the Masses. If you've got any questions at all about this show, or you want things covered in future shows, make sure that you comment on the YouTube video itself. We see that every week and we can respond and reply to that. So Damien, I think I've covered everything there. I think that's all that's left to say. You usually say this bit, but I'm going to say it. I think all that's left to say is until next time.
Until next time.